Welcome to IAS Project. We are continuing with the videos on Indian economy for UPSC Civil Services Exam. Let's look at what gross capital formation is. Gross capital formation, as we have known, is nothing but simply investments. So, gross capital formation is net addition of capital assets. GCF refers to addition of capital assets less disposal of assets. Disposal simply means those assets which are not used and are set aside. Now they cannot be used. So whatever are the addition minus whatever are being thrown out, that is called as net addition. So GCF is nothing but net addition of capital assets. Now what are capital assets? We know a simple definition for capital assets. Capital assets are those assets which are durable in nature and they are used for production of further goods and services. So capital assets have two properties. First property is they are durable. That means they are not damaged within 1 year or 2 years. Generally they last for more than 3 years. Also, capital assets are involved in production of other assets or other goods and services. Example, we have seen industrial machinery. Industrial machinery is not damaged in, let's say, 1 year or 2 years. They are used for many years, and industrial machinery is used for production of other goods and services. For example, industrial parts. So let's see capital assets in detail. Capital assets include dwellings, that is houses, other buildings and structures like dams, reservoirs, companies, thermal power plants, hydroelectric plants. All these are capital assets in a country. Also machinery and equipment. Also cultivated biological resources. For example, mango plants or banana plants or coffee plantation, rubber plantation, teak plantation. All these are cultivated biological resources. For example, if you have a mango plant, you will get fruits for many years. So it is a durable assets as well as it is used in production of mangoes, that is goods. So mango tree or a mango farm is nothing but a capital asset. Similarly, animals, for example, cattle. Cattle are durable. They live for more than 1 year, 2 year or 3 years. And they also produce goods. For example, they produce milk. So other dairy products can also be produced from this. So plants and cattle can also be considered as cultivated biological resources, which means they are capital assets. Also intellectual property products, for example, softwares, movies, patents and all these. Investments for capital assets come from financial savings. We know savings go towards investments, and investments is nothing but GCF, gross capital formation. So investment for capital assets comes from savings. These savings can be domestic savings or they can be net capital flows from abroad or rest of the world. Gross domestic capital formation comes from gross domestic savings, while gross capital formation includes both gross domestic savings as well as net capital flows from abroad. This is important. This shows difference between gross domestic capital formation and gross capital formation. This considers whatever is the investments within India and capital flows coming from outside to India, net capital flows that are coming from outside to India. This means basically domestic savings. So if we talk about GCF, that is gross capital flows, we have two approaches to measure GCF, that is funds flow approach and commodity flow approach. Let's look at funds flow approach first. In funds flow approach, GCF is measured as gross savings of institutional sectors plus net capital inflow from rest of the world. What are institutional sectors? We have already dealt this in our previous video. We have said that in SNA 2008, there are 5 institutional sectors. They are non-financial corporations, financial corporations, general government, NPISHs and households. So these are the 5 institutional sectors. So GCF can be gross savings of institutional sectors plus net capital inflow from rest of the world or abroad. And when we say net, it simply means inflow minus outflow. Funds flow approach for GCF estimation is actually better and more accurate than commodity flow approach. This is mainly because funds are easy for tracking. So data for funds flows are easily available. Therefore, funds flow approach is comparatively better and more accurate than commodity flow approach if we want to estimate GCF. Let's look at what commodity flow approach is. Investments made in different type of assets forming part of GCF are measured in two ways. That is, you can measure industry wise. For example, what is the investment in agriculture industry? What is the investment in industry? What is the investment in mining? You simply add it all up and you get industry wise GCF. You can also do it institutional sector wise. You can see what investment is going into NFCs or non-financial corporations, into financial corporations, and so on. These two are nothing but funds flow based approach. So if you use these two, it is called as funds flow approach. In commodity flow approach, GCF is estimated by three types of assets. What is gross fixed capital, what are inventories, and what are valuables. You add these three up, then you will get GCF in commodity flow approach. Let's see what these three are. Gross fixed capital is nothing but fixed assets like buildings, plants, machinery which are used in production. It can also include trees, as we've seen example of mango trees or rubber trees, teak trees, etc. Also animals, for example cattle that are giving milk. Gross fixed capital can also include intellectual property like software, movies, artistic work, patents, etc. Then what are inventories? Inventories are nothing but input materials used in production or semi-finished goods or unsold finished goods. So all these three are called as inventories. Inventories are measured using net basis. Before understanding what net basis or what stock is, let's try to understand a concept called stock versus flow. Stock is any measurement which can be measured at a particular point. Flow is such kind of measurement which is actually measured over a period of time. For example, if I ask a question to you like, what is the balance in your bank account right now? You will say 1 lakh rupees. This means that the balance in your bank account is a stock. It means that it can be evaluated at any particular point of time, whatever is the value of it. If I ask you, what is your income? You can say 1.5 lakhs per month. Or you can say, let's say 20 lakhs per annum or something like that. So when you measure a value in some time, particular time, then it is called as a flow. I hope you understood stock versus flow with this example. Stock as a property can be defined at any point, at any single point of time. However, flow needs a time gap or time period to measure it. For example, your salary is 1.5 lakhs per month. You cannot say, if I ask you what is the salary today, you cannot take 1.5 lakhs. 1.5 lakhs for what? For 1 month, 1 day, 1 year? What is it? So then it is a flow concept. Inventories are a stock concept. It means that you can say what is the inventory today. Therefore, inventories are measured on net basis. What does this mean? You can say inventory on 1st July is 100 pieces. On 31st July, you can say 200 pieces. This means that you have added an inventory of 100. So this is the net inventory for the month of July. This is what net basis means. You can simply make a difference between two time periods and you will get a net. This is called net basis, and inventories are measured on net basis. The third one is valuables. What are valuables? Valuables are nothing but those expensive and durable goods that are a form of investment. Examples include works of art, paintings of famous peoples, precious stones, precious metals, jewelry. All these are called as valuables. In India, previously valuables were treated as consumption. But in the new series, that is in 2015, when base year was changed to 2011-12, now they are treated as assets after the new series. We must understand there is a small difference between fixed assets and valuables. What is it? Unlike fixed assets, which are used in production of goods and services, valuables are just investment and a store of value for future needs. So, valuables are not used in production of goods and services. Fixed assets are used in goods and services production. However, both valuables as well as fixed assets are durable. But valuables are not used in production of goods and services, and they are just held for the purposes of investment. And they act as a store of value for future needs. For example, if you purchase gold, gold is not a fixed asset, but it is a valuable. because using gold, you're not going to produce any goods and services for that matter. But you can store gold, and let's say after some time the value of gold appreciates. Now it becomes a useful investment for you. So that is the difference between valuables and fixed assets. Let's follow up in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.